For 54 years, one tactical strategy has never lost more than 10% in a single year. Not during the 74 stagflation, not in 2008, not during COVID, not during 2022, the year stocks and bonds fell together. 10%, maximum in every crisis for 54 years. This is protective asset allocation, PAA. And the math behind that floor is what makes it different from every other tactical strategy. Most tactical strategies face the same trade-off. You can protect against crashes, but you give up returns. Or you can maximize returns, but you accept deep drawdowns. The permanent portfolio gives you a bulletproof line with 7% returns. BAA gives you 14% returns with a 29% max drawdown. Most investors want something in the middle, market-like returns, drawdowns under 15. No months of watching stocks rally from cash. Wouter Keller asked the very specific question in 2015. Is there a rule that protects against crashes smoothly without a binary on-off switch? One that increases defense gradually as markets deteriorate? That question produced PAA. PAA was published by Wouter Keller and Jan Willem Kuning in 2015. The design philosophy is different from every other strategy we cover on this channel. Instead of checking a single momentum signal, PAA checks the breadth of positive momentum across a broad basket of assets. If most assets are trending up, stay fully invested. If many are breaking down, gradually rotate into bonds. The key word is gradually. Unlike GEM or B. A, which flip 100% offensive or 100% defensive, PA, A scales its defense along a continuous curve. That smooth transition is what keeps drawdowns shallow even during sharp regime changes. The strategy uses 12 risky assets and counts how many have positive 12-month momentum. That count drives the whole allocation. Here is the actual mechanism. Every month, PAA checks 12 risky assets. US stocks, international stocks, emerging markets, real estate, commodities, and several others. For each asset, compare the current price to its 12-month simple moving average. If the price is above the average, the asset is trending up. Count those positive assets. Call that number N. Now the formula. The protection factor equals 12 minus N divided by 12 multiplied by 2. That constant of 2 is what Keller calls aggressive. Use 1 for conservative or 4 for very defensive. Whatever is left of the portfolio goes into the top 6 offensive assets by individual momentum, equally weighted. So if 10 of 12 assets are trending up, the protection factor is 2 divided by 12 times 2, which equals about 33%. 2/3 offensive, 1/3 defensive. Treasuries. When breadth collapses, the defense ramps all the way up to 100%. That is the math. No binary switch. A dial. Over 54 years, from January 1972 through March 2026, standard PA, it delivered a compound annual growth rate of 10.5%. The S&P 500 returned 10.7 over the same period, so you get market-like returns. But look at the risk side, maximum drawdown of minus 9.8%, less than the permanent portfolio. A fraction of BAA, a small fraction of the S&P, volatility of 10.3%, lower than a 60-40 portfolio. Sharpe ratio of 0.92, higher than most individual asset classes. $100 invested in 1972 grew to about $20,000 by today. That matches the S&P's growth, but the path was 3 times smoother. The defining number is the drawdown, under 10% for 54 consecutive years. That is the defining statistic of PAA. Here is what 54 years of PAA looks like. The cyan line is PAA. The gray line is the S&P 500. 2 things jump out. First, both lines end in roughly the same place. The final numbers are similar. Second, the paths are radically different. The S&P has the classic bull-bear rhythm. 25% up years, 35% down years. Every decade contains a major crash. PAA, on the other hand, draws a line that almost looks sketched by hand. Small bumps, minor setbacks, but never a single deep plunge. In 74, the S&P lost 37%. PAA finished flat. In 2008, the S&P crashed 55%. PA, A lost 9. In 2022, the year everything broke, the S&P lost 25%. PA, A lost 8. And through 2023, 2024, and into 2026, the line just keeps going. It never falls off a cliff. Now let me give you the real picture. PAA has 3 honest trade-offs. First, gradual protection means you rarely catch the full upside of a rebound. When markets bottom in reverse, PAA is typically holding some bonds. It participates, but with one hand tied behind its back. Compared to buy and hold, you miss roughly the first 10% of every major rally. Second, monthly rebalancing discipline is non-negotiable. The whole strategy depends on recalculating breadth every month. Skip a month, and you lose the dynamic protection, potentially during the exact regime change that matters. Third, 2022 exposed a theoretical weakness. When stocks and bonds fall together, the defensive allocation helps less than the model assumes. PA still held the 10% line, but barely. It is not immune to systemic shocks that hit every asset class. Let me walk through each major crisis. 73 to 74 stagflation. S&P down 37% over 2 years. PAA's breadth signal went defensive early. The strategy finished the period flat. 87 Black Monday. Stocks down 30% in a day. PAA had been mostly defensive for months leading up to the crash, thanks to deteriorating breadth. PAA ended the year up 3%. 2000.com. S&P down 49% across 3 years. PA stayed defensive through most of the bear market and ended the period up 4%. 2008 global financial crisis. S&P down 55%. The breadth signal was in maximum defense mode by mid-2007. PA lost 9.8% for the year, still under its floor. COVID 2020. S&P crashed 34% in 30 days. PAA was already 60% defensive because emerging markets and real estate had been breaking down. PAA lost 5%. 2022, the bond stock correlation crisis. S&P down 25. Bonds down 12. PAA lost 8, the closest it has ever come to its floor. 6 major crises. The 10% line held every single time. PAA is built for a specific kind of investor. First, people who want market-like returns but cannot tolerate market-like drawdowns. 10% is a manageable loss. 35% is not. Second, investors who want more active management than the permanent portfolio but who find BAA's 100% concentration uncomfortable. PAA is always diversified across 6 positions minimum. Third, people managing taxable accounts where frequent full rotation would generate short-term capital gains. PAA's gradual rebalancing produces fewer large trades than GEM or BAA. Fourth, retirees worried about sequence risk. A retiree drawing from a PAA portfolio faces a fraction of the volatility of a 100% stock portfolio, which translates directly to longer portfolio survival during the critical early retirement years. PAA is the strategy I recommend to anyone who asks for the middle path. If you want to implement PAA, BestFolio tracks the live breadth signal every month. You see exactly how many of the 12 risky assets are trending up, the current protection factor, the top 6 offensive holdings, and the defensive bond allocation. Full backtest through 1970. Over 80 other tactical strategies tracked at the same level of detail. Link in the description. If you found this useful, subscribe. I break down a different strategy every week with real data, honest trade-offs, and no hype. Next week, Dual Momentum, Gary Antonacci's 2-rule framework that goes beyond his famous GEM to capture both absolute and relative signals. See you then.